Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, July 11th. A week full of bad tariff news will likely end with no major damage to investors' sentiment before the earnings season officially kicks off next week. Plus, US Treasury auctions this week saw strong demand and the US dollar is recovering losses. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So sentiment across major US indices was surprisingly positive this week, considering an avalanche of relatively high tariff rates announced throughout the week, some of which were actually quite shocking, like the 50% tariffs on copper and on Brazilian imports, between 25 to 40% tariffs on Asian nations, and possibly 35% tariffs on the Canadian goods imports. But investors around the world took the news with no apparent stress. They actually could have worried that the tariffs, these huge tariffs, would lead to significant spikes in inflation levels, in price levels in the US, potential disruptions in global supply chains, unnecessary economic slowdown, the combination of which would lead to a possible stagflation, so slow economic growth and high inflation, and a hands-tied Fed faced with stagflation. But no, we haven't seen any of that risk being priced into the equity markets. On the contrary, the S&P 500 claimed a second all-time high level this week as Nvidia helped boosting appetite in AI stocks. Then strong earnings and positive outlook from Delta Airlines sent airline shares flying yesterday, with Delta Airlines adding as much as 12%. United Airlines jumped 14%, while American and Southwest Airlines jumped nearly 13 and 8% respectively. So improved demand for travel also served as a hint of improved consumer sentiment in the US, which has taken a hit, remember, recently due to tariffs, and supported cemented hope that US consumer spending will defy the tariff hikes. So we hope it will. While strong sales of US treasuries throughout this week also came to support the bullish sentiment among investors this week, because global investors simply signaled that they are quite ready to continue to buy the US debt and finance Donald Trump's big and beautiful tax bill and the US exploding debt levels across the Atlantic Ocean. The lack of news about a trade deal between the US and the European Union kept investors in a sweet wait and hope mode and sent the Stoxx 600 index to the highest levels in a month. Elsewhere, the closely watched Japanese 20-year bond auction went relatively smoothly, actually quite smoother than expected by many. The demand there was below long-term average, but it was strongest since March this year. As such, the Japanese long maturity yields are lower this morning. Hallelujah. The 20-year yield is down to 2.5%, while the 30-year yield is testing the 3% level. To the downside, they still remain quite high, but they are coming lower. As such, risks continue to be ignored by global market investors. Good news grabs all the attention, while bad news, and there are bad news on the wire, is brushed under the rug quite rapidly. So you don't need CNN's Fear and Greed Index to conclude that there is extreme greed in the markets these days, which also pushes Bitcoin, for example, which is a highly sensitive asset to risk, to fresh all-time high levels, with eyes set on the $120,000 per coin mark as per options trading. So it is in this atmosphere of, I believe, fragile optimism that the earnings season will be kicking off next week. I say fragile because the earnings growth expectations for the S&P 500 companies have been revised lower, remember, from nearly 10% to around 5 to 7%, while the S&P 500 stocks were busy climbing the Everest. So while lower expectations are obviously easier to beat, and the softer US dollar in the second quarter of this year should help sweeten revenues there, the impact of trade uncertainties remains highly uncertain on revenues and on company outlooks. But anyway, you know what? The big bank analysts continue to raise their year-end forecast for the S&P 500 and for Nasdaq 100, and the pessimistic analysts like JP Morgan's Marco Kolonovich, for example, are simply and gently being pushed out of their job. So it is quite hard to call for a market correction, mind you. So, well, up we go and hope that tariffs won't hurt much. In the FX space, the US dollar is better bid this week on easing stress about tariffs and the softer perception of the exploding US debt, even though these risks persist. So the euro dollar consolidates below the 117 mark. Cable is preparing to test the 135 support to the downside, which also matches the 50-day moving average, and the dollar yen remains bid. The pair is trading near the 147 level at the time of talking this morning. So given the strong bearish positioning in the US dollar since the beginning of this year, we could eventually see the US dollar's rebound gain some more momentum in the coming days and in the coming weeks and pull the major peers lower. But note that while the euro dollar will remain in the year-to-date bullish trend zone above the 112 mark, which is the major 38.2% Fibonacci retracement on year-to-date rally, Cable will maintain its positive outlook above the 131.40 level. While the margin for the yen is much smaller, the dollar yen will be stepping back to the bullish consolidation zone above the 147.50 level already. The upcoming upper house elections in Japan and doubts about LDP's ability to maintain majority is weighing on risk appetite for the Japanese assets, including the Japanese yen. Trade tensions with the United States are obviously not helping either, so the Nikkei in Japan remains under pressure despite a certain relief that we saw in the JGBs and the cheaper Japanese yen. Politics could be a major driver of sentiment in Japan for the next few weeks. I will be preparing actually a detailed talk about the Japanese elections next week before the July 20 election. Elsewhere in the energy markets, US crude failed to clear the 200-day moving average yesterday and fell more than 2% despite news that OPEC would stop bringing extra barrels to the market after waning the last chunk of the 2.2 million barrel per day oil restriction. So they will announce a last 550,000 barrels increase to the market in September and stop there, fearing that too much oil would send oil prices to undesirably low levels. So there are other actually news on the wire that are contradicting. Some are hinting at stronger sanctions against Russia and its oil. Europeans, for example, now want to pull the price cap for Russian oil from $60 to $45 per barrel level, while a new bipartisan bill in the United States proposes to slap 500% tariffs. Yes, 500% tariffs on goods from countries that buy Russian oil, and that would be China and India, which basically buy around 70% of the Russian oil. So depending on what these emerging market giants would do, demand for US and Brent crude could actually see a leg up and push WTI and Brent prices higher. Last oil bulls are nowhere to be found this morning. Even the news that Red Sea is boiling again doesn't help. So the key support for the US crude remains at $65 per barrel level and Brent crude at $67 per barrel level. Note that below these levels, oil will return to the first half's bearish trend. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.